What's up, guys? It's Mr. Fit to Flourish, and today I wanted to talk about how to choose options, the specifics on choosing options. So getting right into it, what is an option? So an option is a contract on a stock, and it's like buying insurance on a stock. So it gives you the right to buy or sell a stock at a predetermined future date. When we're looking at options, there's two types. There's calls and there's puts. So a call option is betting that the stock is going up, and then a put is betting the stock is going down. Okay, options have strike prices, which are predetermined prices where the option can be exercised, and then you have expiration dates, which are the dates that the option expire. So when we're looking at this, we need to understand that all an option is a bet, and it gives you leverage. So what is leverage? Leverage is putting a small amount in and getting a lot out. So the reason a lot of people buy options is because they're pretty cheap. Okay, so you can buy an option for 13 cents or $13. So in this case, if the option was 13 cents, then it's really the premium you're paying is $13 because there's a multiplier of 100. So an option contract, one contract gives you control over 100 shares. Okay, but they're cheap. They're only 13 bucks. So for something like Nvidia, where it was $1,000 per share, you could have bought an option contract anywhere from $50 to $100 instead of buying the actual share. And if it went from if the option, or not the option, if the share went from $1,000 to $1,050 in a day, then that's $50 gained. But if the contract was only $50 and went to $100 in a day, then that's $50 as well, but you just doubled your money. So if you put a lot more in, then you would have doubled whatever amount you put in. So that's why options are amazing. Okay, so let's talk about some of the nomenclature when it comes to options. So for options, today we're only going to be talking about calls. So let's take that into account. But if we take a look at this here, then you can see that in the money is over here, out of the money is here, at the money is here. So this stock that we're talking about, ABC stock, is worth $43 currently. So this is at the money. So this is the current price. If we pass this amount of money, that's called in the money. So we're past $40, $41, $42, that's in the money. And then at the money contracts are at the current price, and then out of the money is where we're going to. So we think the stock is going to $44, then $45, then $46. Then these are out of the money strike prices. Okay, so out of the money strike prices. Now, when we're looking at options, there's Greeks. These Greeks make up the value of the option. So the most important Greeks are going to be delta and theta. So delta basically tells you how much the option value will increase or decrease with a $1 change in the share price. Okay, and it's also equal to the percent chance of the option becoming in the money at some point. So if it's 0.5, if the delta is 0.5, then that means that for every dollar move that a stock makes, so let's say that stock that was $43, if it goes from $43 to $44, then your contract is going to gain $50. So 0.5, multiply that by the 100, the multiplier, 50. So you'll gain $50 for a $1 change in the underlying asset. It also means that it's likely over 50%. It's a 50% probability that the option will finish in the money. Now, the next one that Greek that we need to talk about is theta. Theta is the pay to play. So this is how much the value will decrease every day, keeping the share price and volatility constant. So theta of negative 0.64 is that, meaning that your option contract will lose $64 for every day you hold it. So you want smaller thetas and you want bigger deltas. Okay, smaller thetas and bigger deltas. So let's take a look at some trading strategies. So today's example, I'm going to talk about AMD. So this is AMD on the weekly time frame. So I do a lot of technical analysis here. So it looks like we're in an uptrend, which is very good. We had a small pullback here, also known as a correction. And I have these lines drawn. It looks like we're forming support here on AMD. Looks like we're forming support. We did a Fibonacci retracement here on the weekly time frame. Now, If we go to the daily time frame, it looks like we're holding pretty well. We're trading in this range. Our point of control is right around 164. So that's where we should be going to test. But I believe here at 160 we have psychological support. I believe that we're going to be making a move to the upside since we're holding really well here. Okay, if we get below 156.90, then AMD is cooked. Today is June 16th, by the way, June 16th, 2024. And I think that this is going to be moving to the upside. Now, how do I determine what strike I'm going to be looking at and what I want to do? So if I'm day trading this, then I'm going to be looking to get calls potentially. I want to look at the 5-minute time frame and see how we've been trading previously. So previously it looks like when we get to about 158, then we make a move to the upside. Yeah, we get to about 158, we have these massive wicks. We make a move to the upside. So if I'm day trading this, then I'm going to be looking at buying calls whenever we get down to 158. And it looks like we go from about 158 to where are the moves? Up to anywhere from 161 to 163. All right, it's about 163. Cool. So what I'm going to do is I'm going to go over to options profit calculator, and I'm bullish. When you're day trading, you want to get option contracts that have the closest expiration date, because your data doesn't matter. So you want to pay a cheap amount if you're just day trading. So if the option expiration is closer, then your contracts are going to be cheaper. Keep that in mind. That's how you day trade. If they're further out, then that's really further out options expirations are going to be more expensive, and they're really for swing trading. It's like if you're holding that contract for more than a couple of days, then that's when you want to get further out expirations, because theta is going to be less, but the option is going to be more expensive because you're giving the shares, the underlying, you're giving it time, you're giving your contract time, or the shares time to get to that price. So because you're betting that it's going up, you're giving your contracts more time for it to reach that price. So you're paying for time basically whenever you get further out expirations. So there's intrinsic value in stocks and extrinsic value in stocks, and the extrinsic value is the time and volatility. So you're paying for that. So let's get the price. Current price of AMD is 159.2. We're going to be buying contracts, and then this is where we're selecting options. So these are the different dates. We want to choose the closest date since we're just day trading in this example. And currently, this is the strike price. So this is at the money. These contracts are in the money because we're past these prices. These are out of the money. I always get out of the money contracts. They're cheaper and they make you more money because the delta to contract price ratio is bigger. So another big thing, another key point is the delta to contract price ratio. I like to look for a ratio of anywhere from like 15 to 50%, something like that. Basically meaning if the contract is $100, so for instance here, this is like $100. If I choose this contract at 165 strike, the contract is $130, then I want my delta to be like 0.4 or 0.5, something like $40 to $50, because it's like a 25% intrinsic value gain for a dollar move. Okay, so in this case, I would be looking at the 165 calls for a day trade. These are pretty cheap. I'd select this guy here. And then you can get however many contracts you want. Let's say you get 10 contracts, so that would be $1,340. And then you can pretty much, on this, I like this website, Options Profit Calculator, because it'll calculate what your expected gains would be. So currently we're trading at the 159.2. And then if we go from 159 to 162, then on that trade, we just made 20%, $280. So this gives you the estimated value that we would make. And how did I choose that strike? Well, I wanted it to be pretty close. So we want the closest date, and then I know that AMD on a daily basis moves about $3. So this 200, if you can afford that, that's fine. But I wanted to get something like this, like $134. And then if we look at the delta on that, it's probably pretty good as well. But again, I told you what I'm looking for in delta. And then the last thing you want to look for is the volume. The volume needs to be above 500 and the at least 500. But typically these volumes are in the thousands, which is really good. And then implied volatility needs to be less than 50% on your contracts. And this goes for swings and day trades. Day trades, they could be up to 100%, but but you want to be careful with those. But in general, you want your IV, your implied volatility on your contracts, to be less than 50%. All right, now we're going to look at some swing trades. So let's say that I wanted to swing. If I wanted to swing AMD, which I kind of do, we've been holding this level for quite a while. And let's say that in a couple days, I think AMD will be up at 170. So we're at 160. I think we're going to make a $10 move. Well, how do I know what strikes to pick and what expiration date to pick? So my general rule is that I go out of the money, and I'll go out of the money based on the ADR, the average daily range that the stock makes. So AMD typically makes pretty big moves. So if I go here, hover here, 162 to 166, so it's about a $3 to $4 move every single day typically that AMD makes. So then I think, okay, well, if it makes a $3 to $4 move every day, I'm going to multiply that by about 4 to determine my strike price. So 4 times 4 is about 16. So my strike price that I would choose from 160 would be 175, would be the 175 strike price. So if it makes a $4 move every day, I multiply that by 3 or 4, and so my strike price would be 175. So 4 times 4, the daily move, 175. That's my strike. Now, what is going to be my expiration date? Well, I think it's probably, based on how it usually moves, it's probably going to take about 3 or 4 days to make that move. So I want to give myself plenty time. So if I'm taking 3 or 4 days to make a move, then my expiration date is going to be probably 3 to 4 weeks out. So this is this week's expiration, next week's expiration, the third, and then the fourth week. So I'd pick something like a July 5th, currently here. That's actually really cheap for options. Geez, this is really cheap. So yeah, July 5th, let me see how much July 12th is looking. July 12th is actually pretty cheap as well. So $221 at the 175 strike price. So I would probably do something like that. Give myself plenty time for AMD to get there. July 12th, 175 strike. It's only $221, and I definitely think it will get there by July 12th. So that would probably be my expiration. So I think AMD is going up, so I'm getting calls. And then how fast do I think it's going to get there? I think in about 4 or 5 days it'll get to 170 based on how it usually moves. Because I know in the past, look at these big moves in the past. It went from 146 to 162 in just, to 160 in just 3 days. So 146 to 160 in just 3 days. So and even here it's like doing the same thing. So usually AMD moves pretty good. Price is tightening up right here, so I think we can get there pretty quickly. So if we do get there, then this contract can go pretty crazy. So let's take a look at where the contract can go. So if I choose the 175 strike for the July 12th expiration, it's currently trading at $221. I'll probably get 30 contracts. So I'll pay $6,600. And let's choose a stock price range. So if AMD between that time goes anywhere from 156 to 185, I want to calculate what is the possible gain that I can make. So right now AMD's at like 160. Let's say tomorrow, June 17th, or let's say June 18th, on Tuesday, June 18th, that AMD goes from 159, where it is now, and let's say it goes to 167. I would make a 76% gain on this option, which would be equivalent to $5,040. Now, let's say it gets to, let's say by Friday, the 21st, it gets to 175. Well, I just made 214%, $14,190. So that's a pretty detailed explanation of how I choose my options. I talked about the Greeks. We talked about the expiration date, strike prices, what I'm looking for on the charts. So that's pretty much how I do it every single day. So I think I'm going to actually choose that option, and I'm going to get the 6,000, so 30 contracts on that because it looks pretty good. And I think it'll get there and past. So thank y'all for tuning in. Hope y'all have a good one. Hope you learned something today. It's the Fit to Flourish podcast. It's Mr. Fit to Flourish. I'm out. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.